Okay, what's going on, guys? This is going to be the first video for chapter 1, so try to keep these around a half hour in length. Here's a little Snoopy cartoon. You can read that, kind of cute there. What are we up to in this chapter? Right, well, it's an overview of tax, right? We're going to learn about why we care about tax, what is a tax, how we measure a tax, right? Different kind of adjectives, the marginal tax rate, the effective tax rate, the average tax rate. Who are the tax authorities? The different types of taxes and taxpayers, how we evaluate a tax system, and then we'll look at different tax forms and other tax terms to help you if you go and practice in tax, or alternatively, you just want to do your own return. Right, so starting with tax, right? Any class you take, the first question you should have should be like, why should I care about this? Tax, very important in society, right? It will affect personal finance, right? You want to pay the least amount of tax to have the most amount of income that you keep, right? With your earnings, retirement, investing. Likewise, business decisions, right? What type of business do you want to form, right? Because there's going to be different tax consequences for doing that. Finally, politics, right? This class isn't meant to make you left or right, right? I'm just here to show you what the tax law is. I really believe everybody should make up their own mind, but it does come into play with politics, right? Republicans tend to want less tax, whereas Democrats want more taxation. If you want to learn more of the specifics, feel free to read through this slide here. Don't memorize this for the exam, but if you want to be kind of a good citizen and understand the news, right? When you get old, you start to like the news. A couple things that show you start getting old is when you like Diet Pop or Coke. And you're watching the news. When I was your age, I said I'd never like those things, but now I drink Diet Coke and I'll watch the news channels, the different stations. I'm not one channel or the other. Like I said, I'm trying to present this as balanced and fair as possible. Tax has everything to do with politics, but for this class, it's going to have nothing to do with politics. So we talked about why we care about tax. The next thing we need to know is what is a tax, right? Well, you need to have all three elements, right? It's a payment required by a government that is unrelated to any specific benefit or service received from the government, right? So you need to have 1, 2, and 3. If you have 1 and 2 and not 3, you don't have a tax. If you have 1 and 3 and not 2, you don't have a tax. And if you have 2 and 3 and you don't have 1, you don't have a tax. You need all of them. Let's look at some examples here to give this some kind of verbiage, right? One thing with tax to be aware of, you need to hear this stuff more than one time. A lot of it is just going to be words until we put numbers, examples to it. It's not going to click. So if you're hearing this once and you're like, oh, I kind of get it, very natural, very normal. Watch the video again, put it on 2x speed, right? Keep hearing it, keep seeing it. The more exposure, the better. In any event, right, we have a taxpayer, they go to Alabama, they rent a hotel room, they go to check out. Hey, part of their bill is a 2% surcharge that funds a highway, right? Is this a tax, right? Well, the answer is going to be yes, right? It's a payment required by a government, and the taxpayer in this case doesn't receive a direct benefit. In other words, that highway, right, that benefits everyone. Let's compare that with 1, 2, right? We have a taxpayer, they're building a house, they're assessed $1,000 by the government to connect a sewer system to their house. Is this a tax? Well, the answer is going to be no, right? We do have a payment required by a local government, the first two elements. However, in this case, right, we fail the third element insofar that the taxpayer receives a direct benefit. In other words, this sewer connection, right, that goes out there and that we pay the money for, that benefits just us, right? There's no kind of, societal benefit here. We receive a specific benefit, okay? So need to have all three elements. Other things that do not fit into a tax are just definitionally not going to be a tax. Fines, fees, penalties, right? Fishing license, parking meter fees, tolls. If you get a speeding ticket, that's not a tax, right? So we have the three elements, and then things just aren't definitionally tax. When we talk about taxes, right, what they do is they really raise revenue. How do you think we pay teachers? We have roads, police, right? Somebody needs to pay for that. Nothing in life is free. So taxes help to fund those things. And when we talk about any tax, right, you can really fit it in this box, right? What you owe is a function of the tax base, the substantive item being taxed, times the tax rate, right? So just say a simple example, you go to the dollar store when once upon a time it was $1, right? Now it's probably the $2 store. But say you buy $10 worth of stuff, right? The sales tax, if the tax we were using was sales tax, is 7%. Hey, you're gonna owe 70 cents, right? When you check out, right, the amount you pay is $10.70, the $10 plus the 70 cents. So that's sales tax. You could also use this for any other type of tax, right? So wages, for example, right? The base here, the item being taxed is what you make, right? So if you made 50 grand and there's a flat 25% tax, hey, you'll owe 12,500, right? So that's like if we whittle it down to as simple as it can be, right? That's the formula. One thing we do have to be aware of, right, is when we talk about the federal individual income tax, the main focus of this class is it's not as simple as just a flat 25%, right? We have something here. Our tax system is a graduated, progressive tax system, and I like to think of it like a bucket system, right? Our item being taxed, our income is kind of chunked out into buckets. We figure out how much we owe in each bucket. We add up all the buckets, and that tells us our ultimate tax liability. So you could do it manually, right? You could use a table, you could use the IRS instructions, or in the real world, you would just use the tax software. It kind of auto generates. But, right, you do need to understand what's going on here. So let's look at an example with The Simpsons, right? Let's say they have $170,000 of total income, of which 160 is taxable, 10 non-taxable, right? So we'll use that taxable amount. We go over to the buckets, right? The rules tell us the first 23,000 you're taxed at 10%, right? So we just multiply down. The next 73,000, 12%. The next 63,000, 22%, right? So you go down, you multiply down, then you go across, right? You add them up, right? You got find kind of a giant bucket here. And hey, if you have $160,000 of taxable income, you're going to owe $25,000, right? So this is a graduated, right? We divide up that tax base, progressive, insofar that it goes from 10 to 12 to 22 to 24. It keeps getting bigger, the tax rates, the more you make. And just one example, right? So one thing for this class is do not memorize inflation adjusted numbers, right? Like I would not expect you to memorize 23,000, 73,000, what the standard deduction is, right? If it says the tax year after it in blue, do not memorize that. This class is not a memorization class. Yes, it is in some ways because you have to know, like learn the material, but I'm more concerned about principles in kind of general understanding and critical thinking than I am memorizing specific items. Now, that's not to say, right, some things you do need to put in the time and memorize. So we'll see at the end, right, some tax forms, some things like that. You really do need to know the blocking and tackling with that. But more of these kind of granular level things like inflation adjusted numbers, no big deal. You could come back to this, right? We'll talk about the marginal average and effective tax rate if you want to see that. But this might be a more manual way of calculating taxes. You could also use a table, right, that the book gives you. And you do need to know how to use this for the homework, potentially the exam. I will give you this table. The first thing is you got to find the right table, right? So they're MFJ. There's single, there's other, head of household, but for this one, it's MFJ. It's like you're looking at the back of the cereal box, right? You're playing Battleship. You go down. Hey, we have 160,000 of taxable income that puts us in here. And then here's our little rule or our cheat sheet that tells us what to do, right? 11,000 plus 22% of your taxable income, 160, in excess of $96,000, right? You do the math on that. Hey, if you have $160,000 of taxable income, you're going to owe $25,000. Same thing, same way to get there, just a different pathway. When we talk about taxes, right, we have to keep our verbiage straight, right? You say tomato, I say tomato. We do need to make sure that we're understanding the words, right? We need to know the difference between marginal, average, and effective tax rate. And in those, right, generally we're going to be looking at taxable income, but the effective tax rate uses total income. So keep that straight. Let's talk about these one at a time. And before we do that even, let's kind of do a step 0 and make sure that we're clear on the difference between total income, taxable income, and non-taxable income. The big thing you need to know for this chapter is that muni bond interest income is excluded. That is to say, it's non-taxable, right? It's like John Cena, you can't see me, right? I can't see it. It's not taxable on there, right? So you could have 100 of total income, of which 70 is taxable, and 30 muni bond interest income not taxable, right? What do we mean by muni bond interest income? Because that's got to be a new term for a lot of you. So if we go back to your financial accounting days, right, if you remember a bond, right, everybody's like favorite accounting 101 stuff, right? Like financial accounting is easy till you hit the bond section and you're like, oh my, right? But a bond in a very like high level is just a lending agreement, right? I'll give you $1,000, you give me 50, 50, 50, and you give me my $1,000 back, right? That 50, 50, 50 is interest income to me. Now, if the person issuing the bond is a state and local government, that is considered a municipal bond. And that income, the 50, 50, 50, is excluded, right? So maybe in Pittsburgh, right, that bridge that collapsed with the bus on it, right? They need to fund and get money to build a new bridge. They'll issue bonds, the city of Pittsburgh. You buy one, you put $1,000, they give you 50, 50, 50. You get your $1,000 back. The 50 is not taxable income. John Cena, you can't see me. He's bad guy John Cena, then he's good guy John Cena, if you like WWE. That is in distinction to all other bond interest income, which is taxable, right? So if you bought an Apple bond or an Amazon or a Nike bond and you gave them 1,000, they gave you 50, 50, 50, that is taxable. So just muni bond interest income is excluded. Okay, now that we know that, let's talk about these different adjectives, right? The first is the marginal tax rate. Margins always mean like you're on the edge, right? The fringe there. Here, when we talk about marginal tax rate, most of the time we're just referencing, like at a very like simple level, what bucket are you in, right? Somebody might say, right, I'm in the 37% bucket tax bracket. And what they think when they say that is that they pay 37% on all of their income. No, that is not true, right? All of the income that got you up into, right, all of these other buckets are taxed at different rates, lower rates. So yes, your marginal tax rate might be 37%, but your average or effective tax rate is probably lower, right? We got to do a little bit of math there. Now it's easy, right? Say that our marginal tax rate, we were in the 20% or the 24% bracket, and we make $1 more, right? On that additional dollar, it's going to be 24%. Where things get a little bit hazy is when we start going inter brackets, right? Up or down, right? What if your income went up 20 grand, right? Some of that is going to be in the 24% bracket, and some of that is going to be in the 32% bracket. So when your income goes up, or alternatively, maybe your income drops, right? So we need to know this formula, right? And essentially it's going to be your change in your tax liability over your change in your taxable income, right? So marginal tax rate, right? It's like Goldberg, who's next? Typically it's what are you going to pay on the next dollar of income? But we have the more specific example down here. Let's give it some numbers. So this one's just showing you again how to use the table, right? If you have 160 of taxable income, right? We did that, so you can look there. Hey, you'll owe 25,000. This one says, okay, right? You're at 160, right? So you're at 160 and you owe 25, which we calculated. But what happens if you won the lottery and you go up to 240, right? In other words, you win the lottery for 80 and now you're at 240, right? So we have 240. We're going to have to go back and play Battleship again with the table, right? Do the little math, the cheat sheet there. It would, if we run the numbers, it would be 43,000. Right, so if we take the change in our tax liability, 240 minus 160, over the change in our taxable income, 43 and 25, right, if we carry that down, right, we just plug it in the formula, right, change in TL over change in TI, 22%, right? In other words, if you have 80 grand more of income, your marginal tax rate on that would be 22%. It cuts both ways, right? You can look at this example 1.5 where your income goes down, right? You would need to figure out what savings or what marginal tax rate would arise by virtue of that. But that's the first term, right? The next one here is the average tax rate, right? We're really just looking at the like show me the money, right? Just the taxable income here. It's essentially what you owe on your taxable income divided by that. So let's look at 1/6 here. Very simple, right? We said, hey, you make and have 160 of taxable income, you're going to owe 25. The average tax rate on that is 15.64%, right? That would be like our response to Mr. Monopoly when he's like, oh, I'm in the 26 or the 28% tax bracket. Well, yes, that's your marginal tax bracket. But when we do the weighted average, you might be in the 15%, have an average tax rate for that. Compare that with, right, average, which is taxable, with effective, which is total income, right? So effective, right? So Queen is effectively a great band, right? We're going to need total. I want it all, right? I want it all and I want it now. Show me all the income for the effective tax rate. We go to 1/7. Hey, remember we said you had 170 of total income, of which 160 is taxable, 10. John Cena can't see me, right? When we plugged it in over 160 for the average tax rate, 15%. Here, we're using 170, the total income, 14%, right? So because we made the denominator go up, right, we made the effective tax rate go down, okay? So just different ways to kind of analyze it. Other adjectives to be familiar with: flat versus graduated tax rate, right? A flat tax rate, the entire base is taxed at the same amount, right? So the dollar store example, if you buy 1 item, 10 items, 15 items, it's all taxed at the 7% sales tax rate. Graduated, right, is where we take the kind of base, right, and we divide it out, we chunk it out in there, with each part either being taxed at a different or same rate, depending on what the system hopes to accomplish. Those are the first two terms. Likewise, we have proportional, progressive, and regressive tax rates. Proportional tax rate, very similar to a flat tax rate. Progressive tax rate means as the tax base goes up, right? So the more money you make, the marginal tax rate goes up, right? So when we look at the income tax, you make more money, you're going to be in that 37% bracket. It goes up and up. Your income, so do your tax rates in those buckets. Regressive is the reverse, right? As the tax base increases, the marginal tax rate decreases. One example was kind of FICA, or self-employment tax. This has a phase out, right? Once you hit roughly like 180, 200 grand, it changes every year. But at a certain point, right, once your income goes up beyond that amount, the tax just totally goes away. It phases out. And when we use these terms, right, it needs to be like what we're focusing on, right? If we're focusing on the tax base going up, that could give one outcome. Another classic kind of example of a regressive tax would be tariffs, right? Because as your income goes up, right, the tariffs impact you less because there's only like a finite amount of goods that everybody needs, compared to maybe somebody who has less income, right? And the goods, the tariffs are going to impact them a lot more proportionally. So we look here at 1.8, there's just showing us a sales tax. 1.9, looking here, just again, some of these descriptors, right? We have 3 taxpayers, 1, 2, and 3. They buy stuff on there, right? If our focus was on how much they spent, right, 70, 50, 30, right, then the sales tax in that case is not regressive. In other words, it's the same for all of them. It doesn't change based on a change in income. However, if we focused on, or I'm sorry, a change in like the base there, but if we focused on their income, right, and we put that kind of in, right, then as their income goes up, 75 to 170 to 300, then the effective tax rate goes from 2.8, goes down, goes down. So in that case, if the focus is income, it is a regressive tax. So it depends, again, on what you focus on in there. All right, with taxes, right? Here in the U.S., we have, the federal government that can tax you, the state government, and then even your local government. And then if you have an HOA, right, it's like a 4th layer of government. But each of them are going to tax you on different things. The federal government, what do they use the revenues for? The military, Social Security, Medicare, infrastructure. State government tends to be public education, Medicaid, right? So Medicare is for when you're a senior citizen. Medicaid is if you are a low-income person and you can't afford health insurance. Transportation, public safety, social services, and then the local government, right, tends to be more local, like the local police, the local infrastructure. Historically, right, you can read through this, do not memorize this for the exam, but the big thing in recent history was the TCJA, kind of Trump 1.0 in 2017, and then in his second term, the One Big Beautiful Bill, right? So lots of changes. I was in practice when the TCJA was released. It was really, one of the cool things about taxes, it's always changing. So if you like learning and kind of constantly evolving, it's good in there. And I was, freshly out of law school and have all my credentials and whatnot. And I was knowing just as much about this bill as a partner who had been there 30 years because it was brand new. So it was kind of cool to see the effects on that. And then in his second term, right, the One Big Beautiful Bill Act, it made some of the changes more permanent and then made other adjustments as well. Let's talk about the different types of taxes, right? So, I like Pokemon. I'm not a huge Pokemon fan still, but when I was a kid, right, I loved Pokemon and all that. My goal was always collect them all, right? And I always liked it when there was like 151. They started getting like too crazy with the Pokemon. Like once there was the ice cream Pokemon, I was done, right? But here we got to collect all the taxes, right? So we got to have at a high level the different types of taxes in play, right? So the income tax, obviously that's going to be the focus of this class. Employment taxes, right? So FICA, if you're an employee, self-employed employment tax, if you're self-employed, FUTA and SUTA, right? So these guys over here fund essentially Medicare and Social Security. FUTA and SUTA help fund unemployment compensation. So if you're laid off or something involuntarily and you collect unemployment, those go in there. All of these are employment taxes, and these are going to be the big ones you see when you look at your paycheck, right? When you get your first paycheck and you're like, oh man, I should make $1,000, and then you see like 700 on here and you're like, big time frowny. The difference there, the 300, was probably the income tax and then your FICA tax. As you get older and you get more kind of traditional jobs, full-time jobs, they'll take even more bites at the apple with like health insurance and things like that. Sales tax and use tax, right? Sales tax is at the final point of sale. Use tax is kind of a companion tax insofar that, say there's a 7% sales tax in PA, you're like, hey, I want to buy a car in Ohio where there's maybe a 4% sales tax. I'll save the 3%. If you bring that thing back into PA and you use it, you're going to get hit with a use tax. Over in Europe, right, they don't have a sales tax, right? They have something called a value-added tax. a VAT, where essentially it gets built into the supply chain as the product is built. So we don't see that here. We don't have a VAT here in the US, but very common in Europe. Property tax, right? It can be on real property or personal property, right? Your home, every home that you buy, at least in Pennsylvania, there's property taxes. They use that to fund the school district. Depending on where you live, right, how much you're assessed, $100,000 house, for every 100,000 you're assessed, it can be 2, 3. I've seen some school districts 5 or 6,000, right? So even when you own your house outright after you pay off your mortgage in 30 years, you still have property taxes. I've lived in other states, right? Rhode Island, for example, had a vehicle tax, right? If you owned a if you owned a car, they would tax you on it. They're ad valorem taxes, meaning that how much you pay is a function of what these things are worth. But yeah, they're a thing, right? So likewise, there's a state and gift tax, right? Who pays this is the person who dies, right? Very hard to reach this, right? It's something like $5, $10, $15 million of stuff you have to give before it even kicks in at the federal level. So there is a federal state and gift tax, but it's very rare for when it actually happens, less than 1% of the time. Some states, including Pennsylvania, have an inheritance tax. Who pays this is the person receiving the item given, right? So if grandma or grandpa passes away and they leave you $20,000, you as the beneficiary, the donee, the person receiving it, will have to pay tax on that. Other types of taxes, state and local, we talked a little bit about. Excise taxes are built into the good or the product, right? So something like gas, if you buy gas, there's usually an excise tax on that. You don't know that you're paying this tax, but the consumer ultimately is the one responsible for it. They're also known as sin taxes, right? Sometimes there'll be excise taxes charged on cigarettes or alcohol. Tariffs, right? Big thing with Trump are the tariffs. Those are taxes imposed on imported goods or services, right? So like theoretically with tariffs, we don't want to import too much stuff from other countries because it will kind of impact our own manufacturing capacity. We want to make stuff in our own country. And by having tariffs, we encourage that outcome. Couple other things, right? So we talked about all the different types of taxes, collect them all. The Pokemon, now we have different types of taxpayers, right? So there's like fire Pokemon, water Pokemon, I don't know, grass Pokemon, I think it is. We have different taxpayers too, right? An individual, right, generally going to be subject to income taxes, property taxes, excise, estate and gift. Business taxpayers, which we'll talk about, right? In this class, we'll see if you're a one-man show, if you have multiple owners, if you want to be an S Corp, an LLC, or a formal C Corp. And then there's also not-for-profit organizations which have to file informational tax returns. They don't actually owe tax. Last thing here, right? Just a little kind of framework in your head to keep this stuff straight. So your friend comes to you, your mom, your dad, they're complaining about taxes, right? I hate this tax. I don't like that tax. You got to keep it straight in your head. What are you talking about, mom or dad? What are you talking about, friend? If they're like, hey, I don't like these taxes in my paycheck, what they're probably talking about is, hey, I don't like the federal individual income tax, right? So any type of tax you can put in this bucket or this framework where it's 1, 2, and 3. Hey, I don't like, paying taxes on my house, right, that I own, right? So it would be like the state individual property tax. You can use this to help you to kind of keep things straight in your head. But with that, we're getting up against the half-hour mark. I don't like to leave these or have these more than that amount. So we'll stop it here and we will see you in the next video.